What is going on, traders? If I showed you this chart right here, would you say that this was Nvidia or the S&P 500? If you said either of them, you'd be right because both charts look identical right now. As Nvidia goes, so does the S&P 500. So is this concentration bad? Well, lucky for you, I've done a deep dive, and here's why I think the stock market can get even crazier in the coming weeks to months. I will also give you my plays, what stocks I'm buying, what stocks I recently bought, what stocks I'm selling options on, and when I'm looking to completely exit the market. You definitely want to stick around. This video is full of gems. Let's get right into it. So as I said, right now, the S&P 500 and Nvidia, these charts look identical, and there's a good reason for this. If you look at just last year, the contribution to S&P total return, meaning the returns that you got from the S&P, how much of that was contributed to the Mag 7, you could see that things were a little bit more even with Microsoft, Apple, Nvidia in the double digits, but then you also had Amazon, Meta, Tesla. Things seemed a little bit more sensible. However, right now in 2024, Nvidia accounts for 32% of the S&P total return. That means if you invested in the S&P 500 in the beginning of 2024 and you made a return from it, 32% of that was attributed to one stock. So then you might say to me, Z, that seems a little inefficient. That doesn't seem like an efficient market here. Things seem broken. That means that the market is going to crash, right? Well, not quite yet. Yes, all bubbles will have corrections, and we have not yet seen an AI bubble correction. However, in general, this is how the stock market works. From 2014 to 2023, the top 10 U.S. stocks market cap averaged 19%, but their share of overall U.S. earnings was 47%. And last year, 69% of overall U.S. earnings came from the top 10 stocks. And if we just take a look at this type of concentration, you could see that actually the stock market, when it's in rising concentration, this is good for the rest of the stock market. It is only in periods of concentration decline, which we have not yet hit. I do think we will hit that within the next year or two, more on that later. But only in periods of falling concentration do we start to get into trouble where, we had the dot-com boom, basically a lost decade. And then you had the 2008 crash happen during that period of falling concentration. I do think we will get something similar in a year or two. But I do think that in the short term, the stock market can actually get crazier and rally more. See, what Goldman Sachs found was that there tends to be a bottom-up effect when these periods of high concentration happen. So all of these laggards, such as the Russell 2000, the rest of the S&P 500 stocks, some of the Dow stocks, etc., those tend to rise in value to match the level of the top 10 stocks that are now severely concentrated, both in terms of the S&P 500 returns and in terms of the S&P 500 earnings. Now, remember at the beginning of the video, I said I did some deep dive research and found some new evidence based on research that I did on why I think the stock market can keep rallying and when I think that the party will be essentially over. Now, I'm not going to try to predict a recession here. I don't think anybody can predict a recession in a timely manner. However, let's take a look at some data here. So right now, the yield curve is uninverted, the most uninverted it has ever been, whether you're looking at the 10-year, 2-year, or 10-year, 3-month. Essentially, this means that the shorter-term rates are paying more than the longer-term rates, and that is still the case. So with that said, what happens when the yield curve uninverts? And more importantly, when does the yield curve uninvert? So I went back and I started taking a look at a history of rate cuts. And if you take a look here in 1991, that was the first rate cut coming out of the 90s. We're coming out of the 80s into the 90s. And what happened here? We hit a recession in the beginning or in the middle of 1990. But if you take a look at when this rate cut happened, I want you to take a look at this. January of 1991, the yield curve was uninverted, right? All throughout 1989 and then 1990. But the yield curve uninverted first, and then the rate cut happened. Let's take a look at 2000, at the dot-com bubble, right? When did the rate cut happen? Right up to the dot-com bubble. The first rate cut happened in January of 2001. So let's take a look at the yield curve. It was uninverted all throughout 2000, and it wasn't until the yield curve uninverted that the Fed actually did their first rate cut. Let's take a look at one more case, which was the Great Financial Crisis, 2008. If you look at 2008, the first rate cut was actually in September 2007. So let's take a look. Yield curve was uninverted. The yield curve was inverted. Then it uninverts, and then the Fed does a first rate cut. Why am I saying this? What does all this mean? Well, all this means is that the market can actually continue to rally. And when the yield curve uninverts, that is still typically bullish for the market in the very short term. Meaning, if we take a look at the S&P 500, the S&P 500 can continue rallying. Obviously, I think we'll get fits and starts here. Like we'll get some pullback, some rally, some pullback, some rally. But until there is a reason for the yield curve to uninvert. Now, why would the yield curve uninvert? Well, remember how I told you that right now the 2-year is paying more than the 10-year, right? The 2-year is paying more than the 10-year. So what needs to happen for the yield curve to uninvert, for the yield curve to steepen, for it to get back to normal, where obviously the longer term rates should pay more than the shorter term rates? Well, one of two things should happen. Either the short term of the curve, the 2-year, the rate should drop precipitously, much more than the 10-year, or the 10-year should increase much more than the 2-year, right? Like one of those two things will happen. Obviously, there's an effect where the 10-year increases and the 2-year decreases by different rates, but one of these two things is going to happen disproportionately. So what would cause the short term of the curve to decrease, right? What would cause the 2-year to tank disproportionately? Well, this is where Papa J. Powell comes in. If Uncle Jerome in the next FOMC meeting or two starts talking more like this, right, where he said that the Fed is ready to cut rates quickly if something happens, right? If there is an indication that the Fed is about to cut, that is when we will get a drop in the 2-year yield. Why is that? Well, the Fed funds rate is essentially a short-term rate. It is the rate that banks and the Fed, et cetera, that they borrow from each other, right? That is what the Fed funds rate is. It's a suggested rate that banks use to borrow from each other overnight. And that is why it affects the short term of the curve much more than the long term, because it is a short term rate. So if the market is expecting, if bond traders are expecting the Fed to cut soon, that means that the short-term rates are going to decline. Now, nobody knows when the Fed is going to cut up until now, right? There was suspicions that they would cut 6 times this year, then it went to 3 times, and now it's to 1 time. And some Fed members even said, no, we're not getting any cuts this year. So it is still unpredictable to the market what the Fed is going to do. But if it becomes really clear that the Fed is going to cut, when they get very close to cutting, then we could see the 2-year decline. With that said, I do think that the initial news that the Fed is going to cut is going to spark a rally in the markets. That's why I said that the markets can continue to rally here, minus pullbacks and rallies and pullbacks and rallies. But I think that the market, the rest of the laggards that aren't in the top 10, can come up like a bottom-up effect that we talked about earlier to meet what NVIDIA and the rest of the top 10 stocks are currently doing. Now, here's the scary thing. If the yield curve uninverts because the 10-year is rising sharply, that is where I think that the troubles can start to unravel. Now, what would cause the 10-year to rise sharply? Well, commercial real estate for one, or even residential real estate. But I think right now the consensus is that commercial real estate is in a really risky spot, right? So if things start to unravel in any of the real estate markets, that is more so tied to the 10-year yield, the 10-year plus yield, right? So if the 10-year and higher yields, if those start rising sharply, disproportionate to the short-term yields, and that is why the yield curve uninverts, right? If that is the reason why the yield curve uninverts, not because the 2-year is dropping faster than the long-term rates, but if the long-term rates rise faster than the short-term rates, then I think that is when the party will be over for the market and for the economy, right? That's when you will see the yield curve uninvert because the 10-year is going up drastically. And that is when the Fed cuts. And this is why I was saying that I did research on this. And I found that the Fed actually institutes a first cut after the yield curve uninverts, right? That is very important because it allows us to not only get a warning signal ahead of time, we definitely buy ourselves some time and know when to exit the market. So I am still a buyer of stocks here, obviously very selectively, not as liberal as I was before. But once the yield curve uninverts, we are going to be getting closer to a rate cut. And when that rate cut happens, to me, I'm not going to say what you should do. To me, that is when I will likely exit the market. So with that said, let me be transparent with you and show you what stocks we recently bought. We bought Apple back in March. I said my next buy in Apple will be 165. And right now, Apple obviously hit way higher than 202. I think the high was like 215. And the reason I bought that obviously was technical, but it was also fundamental. See, I knew that Apple spent all last year buying AI companies, and it was just a matter of time before they joined on the AI bandwagon, which they are one of the last mega cap companies to have done so, and tout what is coming, right? And they would see a boom in their stock price based on their AI offerings in the future. So to me, that was an easy asymmetrical bet. Like I said, not only was Apple at a major support level that we saw back in September, November of 2023, we hit that again, but also I knew that this year they would start touting their AI offerings for the future. Now, we also sold cash secure puts on Tesla last week. Now, I get this all the time. A lot of inexperienced people in the comments, the minute that I mention the word puts, they think bearish. Selling puts is bullish, not bearish. Buying puts is bearish, right? So we sold puts here based on this breakout of this pennant and a retest of this gap. Now, another reason that I sold puts is because it, for me, was a win-win situation. If I get assigned those puts, I get to buy Tesla at 148. If I don't get assigned those puts, then I get to keep $200 per contract. So to me, this was an absolute no-brainer on Tesla. And I do think that leading into the summer, we will see a rally on Tesla because that is when we tend to see rallies on Tesla going into their events that they hold in the summer. And I think this summer, we will get more word on FSD and robotaxi. And I think that those rumblings, will be considered part of the AI bandwagon. And we could see a rally of Tesla pushing it above 200 finally consistently once again. And lastly, I do think it is time, in my view, to start buying bond funds like TLT, for instance. Now, these do pay a dividend, but I don't think this is the bottom for TLT. Like, I do think that, again, it will see fits and starts based on what is reported in terms of CPI, FOMC. Are rates going to get cut? Are they not? What's going to happen with commercial real estate? If we see spikes in long-term rates because of an unfolding in real estate, then TLT will see a drop. But I think like around this range in the low 90s, mid 80s, like I think that is a good range to start piling into TLT for next year, not for this year, for next year and following. When we finally start getting those rate cuts, rates start dropping and bonds start rallying in prices, right? So that is why I'm picking up this. Now, I do think there will be a short-term play. It's not short-term, sorry. I do think there will be a leverage play on bonds as well in terms of options, leveraged ETFs like TMF, etc. But for me, I don't think that time is now. I'm going to wait to see what happens to the yield curve. And once we get that yield curve uninverting and we get a sharp steepening, that is likely when I will start utilizing leverage when it comes to bonds. I don't think that time is now. I think we're far away from that. Anyway, traders, if you want to trade live with me every single day, I trade futures live every single day with the crew. Make sure you join us below. We've taught thousands of traders how to trade futures, how to get funded, how to copy accounts, etc. So if you want to trade live with us every day, make sure you join. If you want to get access to all of my plays, including the plays that I showed you on Tesla, Google, on Apple, etc., make sure that you join. All of my up-to-date plays in real time will be sent. Obviously, what you see on YouTube is going to be majorly delayed. So if you want to join us in real time, make sure you click the link in the description below. Use that coupon code. Also, I'm doing, if you're watching this before June 23rd, I'm doing a free training, a free private live stream. This is going to be live taught by me. You have to sign up using the link below. It's absolutely free. If you are not on the list, you will not get the link to the live stream. So if you want to watch on June 23rd, which is a Sunday at noon Eastern, make sure that you click the link in the description below, get your name on the wait list so that you can get sent the private link to the private stream. Anyway, let me know in the comment section below, what do you think about my analysis? Are you buying NVIDIA? Are you waiting? Do you think NVIDIA is going to tank to $10 like some people are saying? Do you think this is the end of the market rally? Do things look shaky for you? Do things look bullish to you? Let me know your opinion down below. Hit that thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.